Hello and welcome to All Talks with Cafemutual. I am Ridhima Bhatnagar. Today we have here with us Rashi T Bhatia, who is the CEO and CIO of Ashmore India. Hello, ma'am. Pleasure to have you on the show.
Pleasure's mine.
Thank you. So, ma'am, I want to start by asking you that when we see category 1 and 2 AIF, in that private equity and venture capital funds, they give us returns up to 18 to 20%. So, but certain equity funds give us more returns as of now. So, why do you think the investors should look at this unlisted space?
Well, I cover the listed space. So I do public markets. And however, I think it's a portfolio diversification strategy most investors should follow. Equity markets have been on a tear, especially on the small and mid cap side. And they've given obviously stupendous returns over the last few years. Large caps today are more attractive compared to small and mid. We're in a weird situation where public equity markets seem to be giving better returns than all other asset classes today. And that too will revert back to mean as time proceeds. I don't think this is the correct way things should be. There was a time when private would give you the kind of returns that no public markets could think of. I don't think that is steady state as well. So these are cycles. Clearly, right now, the small and mid have had a stupendous cycle. Even the large cap equity public names don't seem to have kept up and don't seem to have given you the same kind of returns. And I think that will change over time.
Ma'am, my next question to you is about so equity PMS and category 3 AIF are similar to mutual funds. Then why do you think the investors should look at this space for diversification of their portfolio?
I think if you really look at most mutual funds out there, they are catering to an audience which is, in general, invests much smaller in ticket sizes and therefore is not used to taking the kind of risks that are assumed that PMS and AIF investors take. As a result, if you look at a lot of the AIFs or the PMS, the active share or the bets that we take on the market away from the benchmark tend to be much higher than what equity mutual funds do. For example, most equity mutual funds have an active share of 30 to 40%, where I think AIFs and PMSs are in the higher 60 to 70% range. We are in that 70% plus range, which means we are away from the benchmark. We are looking at more active return, higher alpha, and which, please be very clear, return comes associated with risk, and therefore it should be taken by an investor who understands risk and return go hand in hand. And I think that's the key differentiation when you look at mutual funds versus AIFs.
And my last question to you is that there are so many strategies in AIF and PMS. How does a wealth manager shortlist them for their investor base?
So, you're absolutely right. There are many strategies in the markets. There are growth strategies, there are value strategies, growth at any price or growth at a reasonable price, or what we do, where we are stock idiosyncratic, so we're more bottom-up stock pickers. The question is, do you follow your strategy through cycles? Are you consistent? Because there will be one cycle in which any strategy will not make money, or one strategy will not make money, and then there will be cycles in which they will make money. What wealth managers should really look for are investment managers who are consistent across cycles. They do not flip and flop, and there's no drift of strategy, right? There's no style drift, as we call it. Because when you have style drift, then you are chasing the market. You're not doing your intrinsic work on what you should be doing in your strategy. If you stay true to your strategy, at some point of time, the market will revert and your strategy will do well, and over a longer period of time, you will outperform. But consistency is key, and style drift is what should be avoided. And I think that's what most wealth managers should look for when they pick investment managers.
Thank you so much for those insights. That was all from today's session. Thank you.